Hey everyone, if there's anything Canadians love to talk about more than the weather, it is real estate. Well, in this episode, we've got Dean Orrico of Middlefield. He specializes in real estate stocks, and he says now is the best time he's ever seen in his pretty long career to invest in the sector. And as always, he gives us his 3 best investing ideas. And hey, if you're loving the Pro Picks segment, you can now get it straight to your inbox twice a week, the best 3 stocks by our guests. You can visit our website, www.inthemoneypod.com, to subscribe to this newsletter or visit the link in the show notes. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. Investing can be intimidating, but it doesn't have to be. With BMO InvestorLine, you have the tools and resources you need to make informed decisions and build a successful portfolio. Their easy-to-use platform, packed with research, tools, and commission-free trading on over 100 popular ETFs, can help you take control of your financial future. Learn more at bmo.com/online investing. Dean Orrico of Middlefield, thank you so much for joining me in studio.
My pleasure. Thanks for having me.
You talk about real estate stocks. I want to know, how long have you been investing in this space?
Good question. So I think I started following real estate stocks when the REITs really came into being. So it shows you how old I am. So when I started in the mid-90s as a young investment analyst at Middlefield, that's really when REITs started to IPO, like maybe a few years before. And that was the time, which predated you, I think, Amber, you're younger than me, when income trusts were really popular in Canada. So basically, income trusts were effectively the REIT structure applied to all different types of businesses. But at the core of it were the REITs. So they'd started maybe 7 or 8 years earlier in the US. So then we started to see a lot of Canadian companies who were in the real estate business realize, oh, this REIT structure, which is tax efficient, start to IPO. So I feel fortunate because I've known these companies really since they came into being and have known some of their management teams. Some of them have been around that long.
I think that's important because I think, you know, at a very high surface, people just maybe think of REITs, real estate investment trusts, as just a play on interest rates, right? And so when interest rates are low, REITs do well. And when they're going up, REITs don't do well. Of course, there's nuance in that. So how do you have a long career investing in this sector when it is so subject to just fluctuations in interest rates?
Well, you're right. A major factor is the direction of rates. And so I've lived through several cycles that, you know, cause some volatility. A lot of that is driven by rates. But over and above that, as you alluded, you've got these different subgroups within the real estate sector that move independent of rates. So rates are a factor, but there's so much else going on. And the one thing that always resonates with me as I kind of look at real estate over a longer cycle is that it's just a function of supply and demand. So yes, rates impact investor preference, and they affect investor demand for real estate, and they affect borrowing levels and, you know, your cash flow, because how much is going out as interest cost, how much is left over for investors. But most of all, it is supply and demand. And if you keep your eye on that, I think you'll do a better job navigating a lot of the noise that often impacts the sector.
Well, let's bring it to the here and now and use this as an example. Interest rates are going down, but guess what? The real estate stocks are not outperforming. In fact, since September, real estate stocks are down. So they kind of peaked in September and they're pulling back. So why, at a time when interest rates are going down, are real estate stocks not doing well?
Excellent question. How much time do we have? Because I can go on about this. So let's take it 18 months back, okay, 2 years back, where rates started going up in Canada. So what started to happen? Investors and they started going up everywhere. But investors finally saw money market rates and GIC rates they hadn't seen in a generation. You could get 5.5%, which is roughly the kind of yield you get on a REIT. So investors were pulling money out of the REITs. The private real estate market was doing fine, but they were pulling money out of the REITs, putting them in GICs. So to your point, rates started coming down again last year. You saw REITs start moving higher because we thought that was the major force that would impact investor demand for REITs. What happened over and above that is that you started to see federal government made a political decision to say, okay, we need to start dialing back immigration, because prior to that, Canada had the highest levels of immigration of any country in the G7. I think the prior 12 months, so for most of 2023, we had about 1.2 million new Canadians come into this country, created all kinds of demand for real estate and services, and people thought, well, that was driving prices higher, so the Liberals decided to pull back on immigration targets over the next 3 years. Investors responded by saying, and specifically U.S. investors responded by saying, well, I don't need to own Canadian real estate anymore. One of the major sources of demand driving prices higher and rents higher is now going away, i.e. immigration. So that created a challenge. Even though rates were coming down, that created a challenge. Then what started to happen with the view that the Trump administration, that Trump was going to win the November general election, rates started going higher, and specifically long rates, i.e. 10-year bond yields. So we basically saw 10-year yields in the U.S. bottom out at about 3.5%. We saw them in January of this year get up to about 4.8%. So that became another headwind. So first of all, you've got immigration. Number two, you've got yields going higher. Because people viewed that maybe this downward move in inflation would be over because of tariffs and those types of things. So yields started going higher. And then, as we come into January of this year, there's all this talk about tariffs. So nobody wants to really buy Canadian equities generally, and more particularly Canadian REITs, if we don't really know how this tariff issue is going to unfold. So I think when you take all that kind of stuff together, even though short rates are coming down, Amber, the reality is there's other headwinds that have kept prices at really low levels.
So that's a great explanation of why the REITs have underperformed. Now this is where you earn your paycheck and you decide what are you going to do about it. Is now a good time to step in, or do you still want to be defensive and cautious because immigration is not going back the other way, right? There's still a move to pull back on immigration. And yes, that tariff threat could potentially risk us being in a higher for longer interest rate environment in the U.S.
Yep. So I spend a lot of time thinking about this. And what I see today is probably the most profound disconnect I've seen in my 20 years of following the REIT market. This is the only sector I still manage at Middlefield. My responsibilities have changed over time, but I still manage the REITs because I've been doing it for so long and I know these companies. But I would say over this period, is that I'm seeing where I think values are and what the market is ascribing to those values as being so significantly discounted that I think this does represent one of the best buying opportunities I've seen in my 20 plus years. So the question is, well, how is that going to play out? What am I going to be right? So what's going to cause REIT prices to move higher? Well, number one, let's talk about the challenges. So what's going to happen with tariffs? I can't sit here and tell you that tariffs are going away, but I think to a certain extent, it's going to be more performative by the Trump administration. It has been more performative. I think they're used more as a negotiating tactic. I think the Trump administration realizes that the tariffs on places like Canada and Mexico would probably do more harm than good over time. When he's talking about reciprocity, well, we don't put any tariffs on the U.S. So I'm taking all of that together, and I think this is going to be an issue that'll get resolved, making the back half of the year, I think, a lot less likely impacted by tariff narratives than this year.
And I guess the question is, it sounds like you're saying this is the best buying opportunity you've seen in 20 years, that they've already priced in a scenario. Like, it's fine to say you think it's going to be temporary. Stocks can still go down even if it's temporary, unless they are fully discounting that worst case scenario. Do you think they are?
I think they are. I think that's the right thing to focus on because, yes, the noise could get worse. And I think this derating in REITs could get worse. But I do believe that at a 25% average discount to NAV, at a price to cash flow multiple that is almost half of what the US REITs are trading at, again, this is why I think you've seen this disconnect that is as profound as I've seen it in a long time.
So when you're talking about this big gap on net asset value, these things trading at a 25% discount, what that really means is if I want to buy a house from you and you say it's $1 million and I pay $1 million, that's the price I'm going to get for that house. That's also the value of it. But the same company that owns a house just like that isn't getting credit for owning $1 million house. They're only getting credit for owning a $750,000 house. Is that right?
That's bang on, correct.
So you can buy real estate right now cheaper in the stock market than you could if you were to transact and buy the physical locations.
Correct. As we sit here today, I can buy some of these very high quality REITs at a substantial discount to what we think they're worth and what the market, consensus values think they're worth. And what's also relevant about this issue is that historically, Canadian REITs have traded very close to NAV. So when we think about, I can get these things on sale at a 25% discount, and historically they've traded at par, that's a pretty attractive trade-off.
Well, that was going to be my next question. Like, do these things always trade at a discount? So they don't. How long? My second one then is how long has this situation persisted? Because it doesn't feel super new. I feel like I've been talking about it for a couple of years. Has this become somewhat of a new normal? And maybe some other asset classes are worse?
Yeah, another great question. So I don't believe it's a new normal. And I think you've got a perfect storm, which is really involving the points we talked about earlier, is just the 10 years moved up, inflation, tariffs, election, US investors. I think all of that stuff is basically aggregated into a scenario where investors say, I don't really need to own REITs right now. I think in the fullness of time, that's going to change. I think investors need to be patient with it. I can't tell you it's going to change in 2 months and 3 months, but I think there's a few catalysts on the horizon that I think will drive a change. And I think the other thing important to highlight is that, again, I get back to this supply and demand. So virtually all these REITs that we own in our portfolios are reporting, and the fundamentals are excellent. Like the supply is constrained, the demand is high, the cash flows are good, they're bumping up their dividends. So it's just validating this view that we've held that these are good businesses. But right now investors are occupied with other things and not focused on them.
So what are you doing in the portfolio? Are you just holding on to these names because you have conviction and a long time horizon? Are you actively adding? What does it look like?
So I'm holding. So we basically run what I describe as a high conviction portfolio. What does that mean? That means we own typically between 30 and 35 names. We know these companies intimately. I know these management teams intimately. I meet with them at least twice a year, if not more so. And we have a really good sense for what's going on in their businesses. And as I get inflows in from investors, I'm buying more.
So how do you guard against being too close to these companies? Because you do know the teams and you do know the managements. So do you ever decide to sell these stocks? Like, what does it look like when you decide I'm out?
Yeah. So you have, as an investor, and I've been doing this for 30 years, you have to really be dispassionate about the investments themselves and not get too focused on, the management team or the relationship you have. At the end of the day, your fiduciary obligation is to investors. So yes, we do trade these names. We move in and out of names, but generally speaking, we have a core set of names that we follow closely. And as long as we believe the fundamentals continue to be very good, then we continue to hold them and add to them.
But I want to unpack, what's the criteria? What would it cause you to say, maybe this is not, I don't want this in the portfolio anymore?
So let's think about sectors. So the office market. So this is by far the most challenged part of the commercial real estate sector. And we've got very little exposure to office right now in our portfolios. So some would say, wow, these office REITs are so unbelievably cheap. Dean, you're, skewed to value. Why wouldn't you own them? Well, the reality is the fundamentals in the office market aren't that great right now. I don't see any real near-term reduction in in vacancy or increase in vacancy, reduction in occupancy. I don't see rents moving higher anytime soon. And a lot of that is driven by the fact that in big markets like the GTA, you've had, increases in office supply, and you've still got companies who are thinking, maybe I don't need as big a footprint anymore.
And we're going to talk about that. There's actually a question about that in the mailbag, because the performance of some of these stocks might actually surprise you over the last year. So that's a tease for what's coming up. Conversely, how do you deal with hype in an area? I'm thinking about AI data centers, right? That seems like the one area where, the fundamentals are going to be great. Microsoft, all these hyperscalers, they're going to need big space to house these, like, lack of a better word, server farms.
Yeah. Well, again, the way we look at our portfolios, we go outside of Canada to get exposure to areas that we can't get in the Canadian market, and data centers and cell towers is a great example. We happen to be very constructive long-term on the data centers. Is there lots of noise around the long-term demand for data centers? Yes, but we do a lot of work on that sector, and we believe, notwithstanding the concerns about DeepSeek and lesser amounts of compute power needed over time, the reality is we think AI truly is transformative. And I think your need for data and data centers will continue to grow.
Back to your diligence, one thing that always strikes me about real estate investors, and they are a different breed. I think we can acknowledge that. They're definitely a different breed of the financial spectrum. Doing the due diligence of, like, literally going out. It's not enough to read the balance sheet, look at occupancy, look at cap rates. How often are you out actually looking at these buildings, inspecting what is there? Is that crucial? Is it not crucial? How do you think about that?
It depends on the sector. So I get out and I've seen a lot of nursing homes and retirement homes, which has been an unbelievable area. Industrial buildings, probably less so, right? One kind of looks like the next one.
You've seen one warehouse, you've seen them all.
You got it. Multifamily, yeah, we do get out and do site tours of multifamily properties, because that's a real management of the business, because you are dealing with individuals who are renting units and the experience they have. So trying to understand how a multifamily building is being run, how some of these multifamily REITs differentiate from one another, that's important to understand. Retail, like, you're driving around retail all the time. You can get a pretty good feel for shopping centers. And our focus primarily in retail is on the grocery anchored, necessity based retail, which is in as good shape as I've seen in the last 10 years. And again, it's supply and demand driven. So short answer is yes, you need to stay on top of these assets. And the beauty of real estate is that you can see it everywhere you go. Everywhere you go.
All right, let's dip into the mailbag now. Our first question, this segment is on Dream Industrial REIT. Given that many REITs, including Dream Industrial REIT, are currently trading near or at their 52-week low, would you consider this an opportunity to invest? This question coming from Ali through the mailbox.
So I own Dream Industrial, and this is part of the Dream group of companies, which was founded and continues to be overseen by Michael Cooper. I had lunch with Michael a couple of weeks ago.
Speaking of interesting characters,
yeah, very interesting character, and as smart as they come in the real estate market. And not all of his dream vehicles are doing as well as Dream Industrial. So he's got an office REIT, which is struggling for the reasons we discussed. He's got some U.S. multifamily REITs that are very small that are struggling. They've just announced a strategic review on one of those. But as far as Dream Industrial goes, I think this is an excellent business. Now, there's an overhang on that sector right now, which I think is primarily driven by tariffs. So if I'm a big, 3PL business, or if I'm Amazon or Walmart and I was looking to sign a new, 1 million square foot lease on a property in the GTA, not knowing how this whole tariff thing is going to unfold, do I slow my decision? Probably. probably. So industrial REITs is one of these areas that's perhaps more impacted by this whole noise around tariffs.
And I want to go one step further. I wonder if we can really be so sanguine about this noise around tariffs, because the ultimate purpose in the US is to incentivize Amazon and Walmart never to open in Canada, instead to open in the US. And I wonder if there's a bigger structural story about what these tariffs are really trying to get at, and whether this is a long-term penalty on the industrial REIT sector.
So I don't think it's long-term. And I think you're right. They're trying to incentivize in the US by virtue of tariffs, company onshoring into the US. So having their operations there. But at the end of the day, will a Walmart, who has Canada as one of its largest markets, ever walk away? Absolutely not. You still got 41 million people here. Consumer continues to be in pretty good shape. So if I want to do business in Canada, and we know as far as e-commerce goes, a lot of it relies on the last mile. So having facilities that can actually deliver products within a 10-kilometer radius to people's homes, that's important. So notwithstanding a lot of this threat of tariffs on Canada, these companies aren't walking away from the Canadian market. Might they slow some decisions? Yes. So then it really does come down to supply and demand. So you might see supply start to get absorbed. Demand might soften a little bit, but over time, these businesses are still renewing leases at 15 to 25% higher than the lease that was in place. So
what metric would you look at? Because you could look at occupancy, which is down, and it's still more than 95% occupied, but 5% is a big deal.
It's a major number, correct?
It's a major number to not be occupied, and that is down from last year. So how do you think about, is this company reaching an inflection point? What are the metrics you look at?
So let's first talk about the fundamentals of the business. Occupancy continues to be relatively strong. And when we look at the demand and leases being renewed, so you follow that quarter to quarter, that continues to happen at a fairly brisk pace. Now, they're not renewing leases at 100% spread to the lease that was in place, but they're renewing them at 20 and 25%. So in our view, that continues to be very healthy. And in fact, 100% releasing spreads is actually unhealthy. So that cannot persist for too long. That tells you there's really something wrong in the system. So what happens?
That's too much froth?
It's too much froth. Okay. And that tells you that supply needs to come into the system, because it's economics 101. If I've got a portfolio of industrial buildings and I'm renewing leases at double the amount that the last lease was, well, people are going to be building more industrial properties, and that's going to reduce. And that's what's happened. So number one, we look at some of those fundamentals actually in the business. You look at the quality of the balance sheet and liquidity, and debt is relatively low at Dream Industrial. So one of the reasons we like that. You look at the coverage on its dividend. That's relatively good as well. So all of those factors come into place. And then you're kind of looking forward and saying, okay, how much new supply is coming on? And the reality is, in industrial, the supply completions is peaking and starting to come down. So over the past 6 months, the leverage has really been with the tenant, because they're able to get some of these leases signed at lower levels, lower than they were prior. But over time, I think the leverage goes back to the landlord.
And actually, quarter over quarter, they did see an increase. So you would add to Dream Industrial here.
Yes.
Let's go to our second question. Do you prefer Canadian REITs over US REITs? Is there a US play that you would recommend? And just over the last year, and actually over the recent history, US REITs as an index have done better than Canadian REITs. Why is that? Do you have a preference?
So the Canadian REITs have underperformed for the reasons we talked about. Whether it was immigration, the 10-year yield went up in the US as it did in Canada, more so in the US than it did in Canada. So today, 10-year yields are about 3.2% in Canada versus 4.3% in the US. But those are coming down, and I think that's positive for the whole sector. And outside of data centers and cell towers, which, as I mentioned, I can't get up here, I think kind of like the Four Nations tournament, this is our time, this is our game, because I think the Canadian REITs are in fact really well positioned. They're trading at a substantial discount to their US counterparts. So when I talk about industrial, multifamily, retail, virtually all of those sectors are seeing the US REITs trading well above Canadian REITs, and I think unjustifiably so. So I think there's better value here, but you got to get through some of this noise that we've been talking about. That's why I think the latter half of the year is going to be better for the Canadian REITs. So
if you're looking at retail exposure or multifamily exposure, you have a choice, Canada versus US, and you're choosing Canada on a on a financial basis, maybe a patriotic question.
Yeah. I don't know if there's much patriotism because investors aren't rewarding me for being patriotic. So I think as far as fundamentals go and valuations go, I think Canada looks really good in a lot of those sectors.
Our third question here is on Boardwalk REIT. I've taken your past advice on Boardwalk. Do you still like the stock? This one coming from Arnie, and it has a similar sort of chart trajectory as all the other REITs, peaked in September and has pulled back since then.
I think it's a great REIT. I own it. I've
this
added
is
to it. Multifamily,
Okay.
That's correct. It's a multifamily REIT with about 50% of its portfolio in Alberta, which is one of the markets in Canada, one of the few markets in Canada that doesn't have rent control. And, you know, it's interesting on the rent control. I'm going to digress here for a second because I was talking to somebody about this yesterday. You know, their view, they talked to me about rent control and I thought, well, Ontario is better because it has rent control. The best metric to determine affordability is what we call the rent to income ratio. So in markets like Alberta that don't have rent control, it's interesting for some people to realize that the lowest rent to income ratio is in Alberta and it's higher in rent controlled markets like Ontario and Quebec. Why is that? Well, it is market dynamics. So if you've got more demand, you can build new properties and those properties can charge market rents. So the supply then brings rents back down again. In Ontario, because if you're in a property that is pre-2018 built, the landlord can only increase your rent by 2.5% or 3%. And as a result, what's happening now is that the turnover on units in places like Ontario is very low because people don't want to leave that unit because as soon as you leave a unit in rent-controlled markets, they go up to market rents.
And then developers don't want to build.
They don't want to build because they can't earn a return.
Yeah.
And in addition, we know construction costs are high. We read about it every day. Development charges are high. They take too long. It's just a lot of challenges in addition to cost that are making development more difficult.
So what kind of exposure does Boardwalk have to Alberta relative to an Ontario?
So they're cross country. They have some They have some Ontario exposure, but 55% of that portfolio is in Alberta. And that stock has come down because even Alberta rents have come down in the last little while, which is fine, but it's still a 98% leased portfolio. So
then do you have to be mindful of energy risk when you're holding Boardwalk? If there's, oil is a cyclical business, there have been some really steep downturns.
It's a great question. What's interesting about Alberta in the last 8 or 9 years is that virtually all of the new employment growth is happening outside of the energy sector. So what you're seeing now is greater diversification of the economy in Alberta, which basically makes it less reliant on the energy sector. Now, if oil goes to $40 or $50 a barrel, will that impact it? Absolutely. But as long as you stay within this kind of $60 to $70 WTI price, gas prices we know are at about $4 an M, that's relatively healthy. That's a pretty good backdrop for the economy in Alberta.
So you would add?
I would.
You like this one. The dividend yield is low at 2%. How should you think about that? Because as you said, normally REIT investors are used to a minimum 5%. What's the nuance there? So
it depends. So, we like higher levels of income, but we've always accepted with Boardwalk that it's a low yielder. And similar to Cap REIT, which is the biggest multifamily REIT in Canada, it typically is a low yielder. So the larger REITs, for a variety of reasons, typically pay out lower levels of dividends, but that's fine with us because we can make up for that with some other REITs we own in the portfolio. All
right, we're going to take a quick break and we'll be back with more of your questions. All right, our next question, this segment is about office REITs. We touched on this a little bit at the beginning of the show. What do you think about the office sector? Is there any hope for REITs in this space post-pandemic? There's got to be a time where these office REITs come back, don't you think?
I don't know if I'd put it that way. So let's go through history here. So pre-pandemic, the office market was humming. We had 2% vacancy in places like Toronto. We'd never seen it that low. Then the pandemic hit and you've seen companies kind of rethink how they want to use their office space, this whole work from home phenomena. And then at the same time, as I alluded earlier, you saw a lot of new supply come on the market. And these were decisions on supply that were made pre-pandemic. But it takes, 5, 6, 7 years to actually, build an office building. So they're starting to come on, supply's increasing just when demand was starting to go down. So you went from 2% vacancy to 16 to 18% vacancy. Now, what does the office market look like today? So yes, a lot of companies still believe in having people in the office. Some have shrunk their footprint, but generally speaking, you still got lots of companies who want and believe that, the best way to achieve productivity and efficiency is in office work. And I agree with that. But I think this bifurcation will likely persist for some time. What do I mean by that? Newer office buildings that are in good locations, have good air quality, have great amenities, they're sitting at 90% plus occupancy. So you've got a suite of older buildings in big cities like Toronto that I think may never come back. They've been 40 or 50 years, smaller windows, poor air quality, not surrounded by amenities when people come to the office, they want gyms and they want good restaurants and all that kind of stuff. And I think that's going to be the challenge going forward. So I'm not worried about, the new CIBC Square, or we've just moved from First Canadian Place, which was built in the 70s, to the Well. These are places people are going to want to work because they have all of these things that employees want. And in fact, we relocated in the last couple of years because we wanted to create an environment that people want to come into the office because we think that's the best way to achieve productivity, better productivity.
Okay. Now, having said that, over the past year, Dream Office REIT is up more than the real estate index, and it has started to outperform. That's over the past year. I know over the last 5 years, it's very different. But having said that, that you can make a lot of money in turnaround stories. I mean, does that not entice you at all?
I think you got to be careful, Amber. I think when you're looking at some of these bounces, they become real trading opportunities. And I think real estate is not a trading vehicle that you could move in and out of in months or in a quarter. I think that becomes a real challenge. Having done this so long as I have, I've never been able to pull it off.
Okay, well, that's good to know, right? You don't get tempted by those turnaround stories because maybe as fast as they come, that's as quick as they go.
You got it.
Let's get to this last question. This is about seniors housing REITs. I feel like it's a good idea given the aging population. This one is coming from Justin. And in fact, those senior housing REITs like Sienna, like Chartwell, they have outperformed.
They've been unbelievable stocks. So again, let's go back on seniors housing. So in Canada, and the US isn't really dissimilar, you've got retirement homes, which are entirely funded by the resident. And then you've got long-term care homes. And long-term care homes are largely funded by the province here in Ontario. 90% of that revenue comes from the province. So it's very infrastructure-like, slower return, but you've got much more certainty of your revenues there than you would in the retirement homes. Notwithstanding that, both are doing very, very well. So you've got Chartwell, which is basically 100% retirement homes. You've got Sienna, which you mentioned is basically 50-50. And then you've got Extendicare, which is almost entirely long-term care. So those are the three main players in Canada. We own all three. And I've been in this business a long time. And for the last 25 years, we've been talking about this aging population. It's finally happening. What does that mean? Basically, the baby boomer, which is one of the largest cohorts of the population, the oldest is now 78. So they're basically getting to the point where they're finally demanding senior living products and services. And that's finally starting to manifest within those REITs, like Chartwell, like Sienna, like Extendicare. The other factor on those, Amber, is that they got hit really, really hard during the pandemic. Because as people were dying, they weren't able to show those units to prospective new residents, and costs went through the roof. The amount of money they spent to bring in new PSWs and nurses went through the roof. And they had to spend it, and they had support from the government to do it. but most of that is now behind them. And so what you've seen happen in the past 18 months is that occupancy is now increasing, costs are lower. So for example, with Chartwell, roughly 80 cents of every new dollar coming in from occupancy is dropping to the bottom line. Incredibly powerful.
Very powerful. But as you said, a lot of these stocks have run up to reflect that. Is it too late? Are they reaching, a top point in their valuation? How much of an exception are these stocks to kind of that net asset value discussion we were having?
Sure. I think that's a valid thing to raise because at the end of the day, as investors, we need to make sure we understand where the fundamentals are relative to the valuation. So your question, is the valuation gone too high? We still think there's good value in these stories because with companies like Chartwell, they've now got occupancy at about 90, 91%. We think that gets to 95%. That's what the company's telling us by the end of this year. Similarly with Sienna, we think that goes to 95%. So there's still lots of cash flow to investors will be rewarded with additional cash flow over time as that occupancy goes up. So bottom line is, I think the sector on seniors housing, and that includes both retirement and long-term care, continues to be really well positioned.
Okay, well, with that in mind, let's get into Dean Orrico's Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer. It offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first pick is Canadian Apartment REIT. It's down over the last year. What's the opportunity? What's the exposure you're getting?
So this is, as the name suggests, an apartment REIT, which is by far the largest one in Canada. I know the management team well. It's extremely well run. So I've got no concerns about how it's run. And then over the last 2 to 3 years, it's embarked on a strategy to basically dispose of older assets and add newer assets that are not subject to rent control because they're built after 2018. And in addition to that, they're also selling non-core assets like their manufactured homes portfolio, which they sold last year to TPG, and some of their European ERES portfolio. So the balance sheet's getting stronger by the day, but the stock is trading at such low valuation. So here's a good example, Amber, of a REIT that's been around for 25 plus years, historically traded at a 5 to 10% premium to NAV. And today trades at about a 15 to 20% discount to NAV.
Okay, is that because occupancy has been falling and it doesn't look like that's falling? I should say occupancy has been falling and it doesn't look like that's inflecting just yet. And there's pressure on rents. They are offering incentives, to try and fill that declining occupancy.
Generally speaking, occupancy is actually held in pretty well at Cap REIT, so I've got no concerns about it. The average rent on a Cap REIT unit is about $1,500 a month. So what's really been a challenge for them is this point I mentioned earlier on turnover. So they typically had turnover about 20% of their units every year. People would leave. A new tenant comes in and they can move the market rent, move rent up to market levels. But because market rents are so much higher than the current rent being paid, people aren't leaving. They're now down to the low double digits turnovers. So that hits cash flow. What does that mean? Is that over time, that's going to be realized. So it's not happening as soon as we would have liked, but it's going to happen over time. And then I think the other reasons why it's traded off is that you've got concerns about immigration, you've got concerns about tariffs, you have all these issues that is primarily affecting foreign investors. We can't underestimate how important it is for a smaller market like Canada's to have foreign investors come in. And in Q3 and Q4 last year, there was this massive sucking sound out of Canadian equities and Canadian REITs At some point, they're going to come back because the valuation disparity is too significant. The tariff issue will come and go. And I think U.S. investors and foreign investors generally are going to start coming back to these REITs. CapREIT is the biggest. What do they typically do? They move to the biggest ones first where they have the most liquidity and can buy stock.
So can you do the math for us? If it's trading at a 15% discount, it historically trades at a premium, what kind of upside?
I think you could get somewhere in that kind of 25% upside over time, if not more, because I think this stock is probably worth closer to about $60, $65 a unit, and it's trading at, high 30s, low 40s.
Your second pick here is Granite REIT. I own this one for disclosure, and I've owned it for a long time, so it's been good to me. But it too has kind of pulled back. Granite is interesting because it started with Magna origins, right? But it's not just that anymore. Talk to me about the exposure you're getting there.
So Kevin Gorey, really good CEO. He was running with his team the Pure Industrial REIT that sold to Blackstone. Then he came over to Granite. And at the time, you're right, it was primarily or a significant number of their leases with Magna. Magna's now down to like 25% of their total portfolio. They've done a great job diversifying away from Magna, having a much broader tenant base. So what's hit it very hard in the last few years is that, during this period where e-commerce was growing and there was more demand for logistics and industrial properties, they started to build properties primarily in the US and started to build them on spec. And then, like a lot of areas, they built too many properties, as did their competitors, and now leasing up those new properties has been a challenge. The good news is that the amount of new supply is rolling over. So you're not getting many new properties come up. I think it's peaking late last year, this year. So as a result, the leverage comes back to the landlord, and they're now finally starting to sign some leases. Not as many as we would have liked, but again, when I look at a company like Granite trading in the high 60s, where I think, this stock could be an $80 to $90 stock over time, it's incredible value with one of the best players in the space.
How much of a risk is that Magna exposure still? Because it is really in the eye of the tariff storm, and 25% is still really high exposure to a single tenant.
Great question. So at the end of the day, what does Magna mean to Granite? They've got long-term leases with an excellent credit. So while Magna may have some issues with tariffs because it could be disruptive to the whole automotive supply chain, at the end of the day, Magna is an excellent credit. They're going to continue to pay their rent. And that's really what Granite is concerned about. So I don't have any issues with Magna at 25% of Granite's portfolio.
Your third pick is RioCan. So this one is your retail exposure. What do you think of this? What's the sort of long-term play with RioCan?
Excellent. Think about retail, and they're primarily, necessity-based, grocery-anchored shopping centers, not enclosed malls. They have some, but it's a very, very modest part of the portfolio. So, like a lot of real estate sectors, you haven't had much new supply. What have the shopping center players been doing? They've been taking their parking lots and putting up condominiums and self-storage and all that type of stuff. They haven't really added more retail over time. Meanwhile, major grocers like Loblaws and Metro and Sobeys are looking for more retail. Now, they typically are the anchor in one of these shopping centers. If RioCan has a space that might have been vacated by a Target or a Toys R Us, that would be normally a smaller footprint, those grocers are taking that space as well. So again, you've got limited amounts of supply. You've got very strong demand. We just saw Loblaws reported excellent numbers. Loblaws is a major tenant of RioCan. So from that perspective, they're seeing increasing rents because supply and demand is imbalanced.
Give me, what do you think the upside is here? What's the discount? What's the opportunity?
So that stock now trades at about $20. It's had a nice move on printing a very good quarter just a few days ago. This could be a $25 stock over the course of 2025. So again, you've got really good upside from here if it just goes back to historical multiples.
Now, I want to ask about RioCan because I feel like it's one of those stocks over my career. Everybody has lovely things to say about it, but the stock itself, over the long term, it struggles. It's not back to even where it was, say a decade ago. So it's not like we're just using the pandemic as its peak. Having said that, over the last couple of years, you can get 80% moves, you can get 30% moves. Is it more of a trading stock? Like, I know people don't talk about it that way, but do you have to look at RioCan as more of a trading stock?
It's a valid point. I think trying to time your entries and exits, if you chose to trade RioCan, I think it'd be very difficult to do. It's the largest retail player. Choice would be very large as well. So from that perspective, you can get liquidity. So you could trade it if you chose to. That stock's been as high as the high 20s, low 30s, if I look back 10 years or so. And the other headwind for RioCan in the past few years is that, like a lot of the retail REITs, they see they've got these parking lots. They see they've got a shortage of housing in Canada. They've been building, apartments and condominiums. There was lots of concern with RioCan that a lot of these condos that they took a deposit on 3 years ago, 4 years ago, were coming due for closing. And there's been lots in the news about people not being able to close because rates have gone higher. They just reported that 98% of those condos actually closed. So they actually got the proceeds for building and selling those condos. That was really positive. They're building up and have built up a whole nother division within the REIT called RioCan Living that at some point I think probably gets sold or IPO'd or whatever the case may be. So I think there's some hidden value in that. So these are some of the things over time that I think will play out, which will drive the stock higher.
All right. Thank you so much, Dean. It's been an absolute pleasure. Thanks for joining me in studio.
My pleasure. Anytime.
That's Dean Orrico joining us of Middlefield. Tune in to our next episode. We've got Paul Harris on the show of Harris Douglas. He talks pretty much every stock under the sun, large caps in both Canada and the U.S. You can get your questions in. Hit us up anywhere on social media at In the Money Pod. You can email us at questions@inthemoneypod.com. Of course, check out our website, www.inthemoneypod.com. Now, if you enjoy the Pro Picks segment, I want to let you know that you can subscribe to our newsletter and get these Pro Picks right to your inbox. So visit our website to get on that newsletter list, and we'll see you on the next episode.